Money does not leave the stock markets. It only rotates. Now, if for you to succeed in the stock market as an investor, you have to follow the money and follow the direction of the money. What we are saying now is that money is moving away from the equity market to the fixed income markets. Welcome to Clockwise. My name is Providence. Today we'll be showing you 5 opportunities to make wealth from the fixed income market, where the money is actually moving to. And I don't do this alone, and you're aware of that. My stock market analyst is here. I'll be looking at 5 different opportunities you can make money from the fixed income market. Now, with a resounding virtual round of applause, welcome, Mr. Kanem. Welcome to Clockwise.
Thank you very much.
Now, we have always advocated on this show that the best strategy to succeed in the stock market is to follow the money. Don't go before the money, don't go after the money, but just follow the money. Now, we are seeing a movement from the equity markets, from the government policies and every other activity in the stock market. Is the money truly moving to the fixed income market as it stands now?
So we've had a lot of money sitting on the sidelines.
Okay.
And so we saw a lot of rotation, especially in the month of June, a lot of people took profit. But the typical thing that happens is that they take profits and then rotate. Either they sit on cash for some time, and then once the market picks up, then they get back into the market. But you see, investors understand very well that when the fixed income space becomes very attractive, that's a cue for them to actually access that space. Yeah. And what we have seen over the past couple of weeks or thereabout has shown resoundingly that the government is very bullish on making the fixed income market very attractive as a way of mopping up excess liquidity from the system and taming inflation.
Do you see that as a temporary event?
Something like the OMO, of course it is. By the way, you know that this is a pre-election.
We're expecting a re-rotation back to the equity markets.
So yeah, I'm going to get to that point. Okay. But you see, this is a pre-election year, and the one thing about it is that most of the time, in fact, statistically, there's a lot of money in people's hands at times like this, and so the CBN. By the way, with the OMO, the CBN is basically going back to what we had about 7 years ago. So the CBN wants to really open this up so that everybody. Because when people come in, if I have money, then if that money is disposable cash, I can use it to buy more things, and then we should continue to push the inflation upwards. Yeah. So as part of what I can call a preventive or a proactive measure to tame inflation, the CBN rolled out this OMO. Very attractive, and then that would kind of get some of it would compete with equity market because it's 20%. Okay. 20% is a very attractive number. You are talking about treasury bills that are sitting on 17 point something. 17, yeah. So, and then you're talking about OMO that you have as high as 20.3, and then when you look at what we call effective yield, because effective yield, like the way it works is that this is discounted. Like T-bills, like OMO, they are discounted forward. So when you look at the effective yield on the money that you put in, that should be 21 to 22%. Yeah. On your money. So that is very attractive. Okay. That's very attractive, to investors.
Now, what happened in a situation where a policy like OMO is oversubscribed? What do you think actually happened?
So yeah, that's true. By the way, it was oversubscribed.
Okay.
The government showed up with 600 billion on offer, and then they had as much as 4.93 trillion in bids. On the August 13th auction. So now what we expect really is that like I've told you, I think we have said on this channel a lot when you have bonds, whether it's treasury bills, whether it's OMO, there's this inverse correlation between price and yield. So the more people struggle to get in, it has a way of bringing down the yield. So we expect the yield to come down. If you look at the T bills, the NTBs, and then you have, the OMO is from the CBN directly.
Yeah.
NTB is from the Debt Management Office. OMO is like an intervention, a short-term intervention. While this one, that's why you have about 133 days. It's not unlike the T-bills that you have up to maturities up to 364 days. So before, what we are expecting is that there will be that equilibrium that will be established very soon. Because if I can get in on 20.3, why would I go to buy 17.5? No, so there would be that upward pressure on T-bills and downward pressure on OMO to get to a particular point where investors believe that they are equally priced.
Okay, now do we believe that there are more opportunities now in the fixed markets?
Of course, there are more opportunities now in the
apart
fixed
from
market.
OMO.
Apart from OMO, so the thing is, like I told you, this OMO, because
Open market
operation, yeah, that's what it is. It's now open to non-bank institutions. You have individuals. You have. So it's
Everybody.
Literally everybody, But of course, you need to still go through your deposit money bank. But that actually allows more people to be captured.
Yeah.
When more people are captured, that means that the guy that was sitting on some 10,000 or 100,000 naira, 200, 500,000, not knowing what to do, would actually I can actually get some interest on this if I participate in this. So you have it's a way of really pooling the resources, like kind of controlling liquidity in the system, and so it provides a huge opportunity for people that have been sitting idly. We're going to look at all the opportunities, the 6 of them, but it allows people that have been, kind of not really thoughtful about their money to begin to say, okay, this can actually work. And because it is risk-free, it means even if you are risk averse, because a lot of people, when you talk to them about the equity market, they will tell you, listen, I can't do the equity market because it's risky, which means it can actually I can lose my money, which is actually true though. But this one is risk-free, completely risk-free. You just have to lock up your money for just over 130 days. And that's all. And by the way, if you look at some of the people, these people, they don't even, some of them for 6 months or thereabout. By the way, 133 days is basically a little above 4 months, So some of these people sit for 6 months, 1 year without touching those pile of cash. So it's an opportunity for them to actually be able to begin to make money from what they have.
Okay, now let's look at these opportunities.
Yes.
You said the opportunity. Let's look at the opportunities.
So the first one, which is what I've done, is number one, it gives our Nigerians opportunity to turn idle funds into money-making opportunities. And remember, I've talked to a lot of people about, why do you sit on cash? I see someone that is sitting on, sometimes you see up to 30, 40 million in a bank account, savings account that pays how much? Peanuts, Okay, why do you sit on this? And guess what they will tell you? Well, this is the one I'm sure of, because they don't really understand that there's that risk-free nature to these fixed income assets. They will sit on that, and then that money is, remember, that money is actually depreciating. So you can turn that idle cash into cash. I know people really that they are very risk averse, but guess what? Because they have been saving over time. By the way, remember that sometimes what people don't remember is that a large portion of pension funds are actually kept packed in this fixed income.
Yeah.
Yes. So what you are really doing, you are averse to participating in the fixed income market. But guess what? You are subscribed to a pension fund administrator or fund manager who is actually investing in that. So it doesn't matter. I think it's education, just getting people to be aware. But the idea is that it provides opportunity for them to turn idle cash into an opportunity for them. I mean, apart from OMO, you have treasury bills, you have federal FGN bonds, you have commercial papers, corporate bonds, though, of course, a few things have actually rubbed a red mark on corporate bonds, but these are just isolated. As far as I'm concerned, what happened to Gerigu is an isolated case, really, which is still under investigation.
It's 1 in 100. It's 1 in 100.
Yeah, it's an isolated case because, but even though it's an isolated case, the reality is that it will definitely make borrowing in the corporate bonds more
difficult,
expensive. Have a higher yield because investors will say, as in like a name like Gerugu that literally pay dividends. By the way, if you look at their half-year result, there's no indicator in the entire income statement that is positive. Everything is negative compared to half year last year, but that's not what we're talking about. But I'm telling you that because of this default, it will make investors to rethink corporate bonds. So you are most likely going to have the credit spread in the higher credit spreads in the fixed income market, because if you look at, an investor will tell you, listen, I think the risk of lending to a corporate institution is now higher than that of, and especially because as a corporate you are competing with something like OMO, which is coming directly from a CBN. So that means, maybe if you're looking at T-bills offering 17% with an effective yield of maybe 19%. Then when if that is T-bills, if that is what T-bills offer, then you could look at, for corporate debt, you can look at maybe adding like a premium of, let's say, 3%. 3% to that is about 20% already, and with effective yield of maybe about 22 to 23%. Now, with OMO offering 20.3, that means that if you are looking at a premium, then you are going to have to add maybe about another 3%, giving you about 23 to 24%. 24%, then with an effective yield of 27%. So what I'm trying to say is that this thing about Geregu is going to raise the premium on corporate bond, and therefore, credit spreads will begin to expand.
All right, let's look at this opportunity.
Then the next one is actually building predictable income. Predictable income. One of the things we talk on Clockwise is do not invest everything in the equity market. I've always said it, and the reason is why the equity market can actually it moves in cycles. You can have the market push high, very high, because some stocks can do 100%, some stock can do. I was looking at something yesterday, and I realized that some names that even with very terrible fundamentals were doing 1,000%. Oh Lord God! So some of these things can do those numbers, but guess what? When they fall like a rock. So on that premise, you will observe that if you put all your money in there, you are not sure that you will get your money back. That's number one. Number two, you are not sure that you can, even if you want to cash out now, what if the market has corrected very seriously? Then you will be sitting on something way less than what you actually invested. So, but what provides that predictable income is the fixed income. Because if you look at something like treasury bills, the way treasury bills work is this. So if you are the treasury bills don't really pay from time to time. No, the idea, it is discounted forward. So, for example, if you give me 100,000, if I'm investing 100,000 in T-bills that comes with a 17% returns. What that means is that I'm buying it at 85,000. So what I'm buying it with is 85,000. Then they will pay me the face value. That's how T-bills work. So what that means is that you are sure that in barring taxes, they only for stock market, for bonds and for OMO, there's no tax. But T-bills have. But barring taxes, you are sure that you are getting 100,000 at a particular date. That is the maturity. Do you understand? So it gives that predictable income. If you are investing in bonds, for example, you can say, okay, I'm getting my coupons at so and so time, and it will come. And bonds, you can literally tell because there's no time. Once you lock in a particular yield, then, I mean, let's say you are able to lock in, let's say bonds give you about maybe 18%, 18.5%, and you lock it in at that point. That means you are sure that every year you are getting 18.5% till the maturity of that bond. So that actually gives something that is very predictable. And predictable income is very, very important because, I mean, if you look at people, especially people that are no longer working, that don't have salaries. I mean, salary can be an addiction. So if you don't have salary, you might want to have something. By the way, even the pension that you think of, the pension, actually, how are they able to fund salaries of retirees? It is also from the fixed income. So it provides an opportunity for people to really get a predictable income source. Okay. Then another thing is, I mean, this should be obvious, is it protects you against inflation, at least marginally. So, for example, what is headline inflation for the month of July? It is for 15.43%. What is the yield on treasuries? You are talking about for 17%. Yeah. 17.59% for hedge. You know, that is so, and then even if you have a stop rate of about 18.5 for instance, that still gives you and then you have inflation at 15.43. That still give you 3%. Okay. 3% barring taxes and every other thing and fees. 3% still gives you a comfortable arbitrage over inflation. So it allows you to protect your money, because the reality is that if your money sits idle in the bank, you are actually losing, you ready? 15.43% every single year. So that money that is currently 100,000, by this time next year will be 85,000 in terms of what it can purchase. Yeah. So you don't want to be able to beat inflation. The barest minimum of what you can do is to invest in the equity market, sorry, in the fixed income market. Okay. I know that, of course, obviously there are other things, there are other investment vehicles that can give you better returns, that can help you to really beat true inflation. Some people say there's what we call inflation and true inflation. And true inflation. Someone said, I know someone who said, I would not mention on this show, but his inflation is actually 26%. His own inflation is 26%. But the actually numbers from the National Bureau of Statistics is 15.4%. Now, another use case of fixed income for Nigerians is a means of portfolio diversification. I've always said it, and I say on this show, if you are an investor, you should have a cash position. A lot of people don't know that cash is actually a position. Yeah. Cash is actually a position. On the cash position. I know somebody, the moment he has one kobo, he says, let me allocate everything to equities. No. Cash is also a position. Cash is, you understand that cash is a position when you see a serious dislocation in the market. Yes, that's why investors, professional investors, portfolio managers know the place of cash. In fact, I know some portfolio managers that their cash position cannot be less than 20%. Their cash position. By the way, so when you talk about cash position here, it allows you to diversify. Because if you look at this, number one, equities can fall. Yeah. Then, I mean, even if you invest in ETFs, equities and all of that, they can fall. But cash at least will remain stable. Not only stable. When I say cash position, by the way, I'm not talking about keeping money in the bank. I'm talking about cash equivalent. Cash equivalent, for example, like cash that you park in money market funds. Yeah. Cash that you maybe buy some of these T-bills, and all of that. So that is exactly, it allows that diversification opportunity for Nigerians. So you could own some equities, you could own some real estate, you could own some precious metals, you could own, if you are the very diversified type, you can also even own crypto, and then you can own, some cash. Yeah. And then the cash also allows you to be able to take advantage of dislocations that happen frequently in the market. I talk about opportunities in the market, and like Richard Branson said that business opportunities are like buses. Another one is always on the way. So but how do you prepare for the next one that is on the way? You prepare. I know people that had gone full into some equities in May, and today they are seeing dislocations and they are not able to take advantage of, because they are already fully invested, and selling their position would literally mean locking in those losses. So you want to be in cash. Cash is a position. If you don't know that cash is a position, then unfortunately I don't know what is. Then the other thing would be that that fixed income allows the ordinary Nigerian to actually participate in the Nigerian economy without really buying equities. If you think about it, like I told you, when you are not aware, when you are not to be able to trade equities, needs some level of understanding of how the equity markets work. But you see, something actually also influences that. So, for example, even if something that is closer to equity, in the fixed income space is the commercial papers. The corporate bonds. Because number one, corporate bonds are priced higher because of the premium. They are priced higher than the fixed than the FGN bonds. So it reflects, and corporate bonds also reflect the performance of the company in such that the risk profile of the company determines to a large extent what the company can offer. Yeah. So the chances of companies are being rated. So a good way of participating in the company, because by the way, remember that the bonds are being serviced, or the debt obligations based off of corporate bonds are being serviced by the earnings, the free cash flow of this company. So you are literally benefiting from the free cash flow of the company without knowing, by doing what? By being part of the fixed income market. Even if you can tell me, okay, how do I know which company? You don't need to do that. There are some mutual funds, money market funds, actually mix all of these two things together. Short-term securities, government bonds, commercial papers. They have managers that actually pull up all of this together, and then that's why you would observe that the return on some of those funds might be higher than if you are buying directly, and all that. So it allows you Nigerians to participate in the stock market without necessarily having to buy any equities whatsoever. Then the last one for me is this. So if you look at, when people ask me to put up a portfolio for them, one of the things I do is I always ask, how old are you? And what are your investment goals? Here is why. If someone is in his 20s, I would say 80%, equity. Minimum of 80% equity and 20% fixed income. And the reason is because there are two reasons. Number one, that person has enough time to recover from any market downturn. That is number one. Number two, that person's liquidity demand is low. If you are in your 20s, what are you losing money for? I remember when
what are you looking for money for?
What are you looking for? What are you having money for? I remember somebody in a session I had with some students. The guy said, that young people now are the ones that are suffering because your parents, you are going to, your uncles, your cousins, and all that. But ideally, your liquidity demand is supposed to be very low. When you are married, that changes, But when you are, maybe if I'm setting up a portfolio for someone that is in his late 50s or 60s, then I know that I need to lean more. At that time, we are big on capital preservation. We are not trying to do aggressive capital appreciation. So when I'm designing a portfolio for that kind of person, I lean more towards fixed income and less towards equities. Except of course, there's a particular client that I had to do, even if the guy is in his late 60s, but he's still overweight on equities. And the reason is because he told me that this investment is not for him, actually. It's for his children, because he himself is settled. His fixed income portfolio, he's already settled, can take care of him for the rest of his... He's also on pension, and the pension is way more than what he needs to be able to fund himself till he goes. So, in that case, you see that the fixed income actually allows for what? For wealth preservation. Wealth preservation. That's why towards the 50s or 60s, your mix, your investment vehicle mix has to tilt more towards wealth preservation, and that can only be afforded by fixed income and less of aggressive wealth accumulation.
All right, now before we go, I'd like us to talk more on OMO.
Okay.
how it works.
Okay.
What is it? Like, what is the benefit of it?
So
those
OMO,
that are just here.
okay, so OMO is open market operations. It's an instrument by the CBN. This one is directly from the CBN. No, it's not. It's
like treasury bills.
no. Treasury bills is from the debt management
yeah.
office. And that is for maybe to fund deficit.
Yeah.
But this one is strictly from the CBN, and it comes in to manage liquidity. So it's a way the CBN uses to mop up excess liquidity. When they think that there's too much money in the system, they use OMO to mop up excess liquidity. That's why you see that they offer at a premium to the T-bills. Now,
before now, it was actually
we had before now. There was a time that T-bills in this country was going for 4 naira. I used to even see a signboard where they would write, "Are you tired of poor returns on T-bills?" And then they use that to advertise real estate opportunities. But I mean, if you look at the fact that the government is very aggressive, our interest, the inflation target is 9%, and we are still at 15%. So a way of doing that is to mop up excess liquidity. It's a way of taming the demand side inflation, and then to some extent moderating inflation expectation. So now OMO is a direct intervention by the CBN to mop up excess liquidity. So as a Nigerian, what you do is you can participate, but you have to participate through your bank. So you can just walk into your bank and say, "Listen, I want to subscribe to the OMO," and there is what we call a single offer, by the way. So your bank, unlike T-bills that you can actually, if you have up to 50 million naira, you can literally bid. But for OMO, you have to walk through DBMs, DMBs, the deposit money banks. You have to, so the bank will pool funds together of all interested parties and then bid as a single entity. So whether you like it or not, OMO is still an auction. So that you bid collectively. And then whatever, then of course
you have to go through your bank.
So you have to go to the banks. You submit it. You can, if you are going to go for the 133 days, you can go 103 days. I mean, you can, depending on the maturity that you want, and then the bank will then tell you what the rate is based on what they actually presented as bid. The thing is that what the CBN would say is what we call the stop rate. Stop rate is the highest rate they can pay. So anybody that bids above the stop rate is automatically disqualified. Yes. So the stop rate is currently 20.39. 20.39. So that means, give or take, you are sure of maybe 20% return. Let's say if your bank submitted a bid for 20%. So then you just sit and wait. That's all. You just sit and wait, and then you will have. And then, by the way, remember at OMO, there is no tax involved. So you are going to get that. And by the way, just so you know, before you think that you are going to get 20% of your money at the end of one, no, it doesn't work that way. So it's a 20% off 133 over 365 days. So
it's at the end of the year.
No, you don't get it. It's not at the end of the year. It's a percentage. For example, let me give you something for math so people understand. If, let's say, you are doing for 6 months, 6 months at 20%, that means you will effectively get 10%. Okay. Because 10%, 6 months is half of 1 year. When they say 20%, that 20% is for a year. So 6 months would be half of that, which is 10%. So for 133 days, you have 133 over 365 days, then multiplied by 20%, and then multiplied by the capital that you invested. So that is exactly what.
Okay, thank you very much. That's a better clarification. Thank you for coming.
You're welcome.
All right, on that note, we've come to the end of today's episode of Clockwise. Please do not forget to like, to subscribe, and also put on the notification bell on this channel. Now, if you want to be part of our community, we have a Telegram link on our profile page that can take you directly to our community where we have real-time conversation, and we do other form of conversation in our community. Please join our community. Now, my name is Providence, and I will see you again.